Proud supporters of Africa this week. Engine, with us, you are number one.
Hello and welcome to this edition of Africa This Week, your wrap of what happened across the continent. I'm Mashudu Masutam. In this first part of the show, Nigeria launches a task team to draft the long-awaited Petroleum Industry Bill within 30 days. And the UN and the World Bank talk this year's prospects for the world economy. The Federal Ministry of Petroleum Resources has set up a special task force to work alongside the Ministry of Petroleum in order to fast-track the passage of the controversial Petroleum Industry Bill. It is hoped the PIB will lead to increased petroleum revenues for Nigeria and new opportunities for Nigerians to participate at every level of the new development in the sector.
The task force will work alongside a technical subcommittee who are also here today. And they are charged with reviewing all versions of the bill and producing a draft within the next 30 working days.
The chairman of the newly inaugurated task force, Senator Udo Udoma, pledged to meet Nigeria's expectations of the new task force.
I'm happy that we will not be required to draft the bill, but there's a technical committee that will do all that work. Ours is ready to liaise and facilitate. It is work that I think that I believe that we will be able to achieve. We'll put in all our efforts, we'll work hard, we'll work tirelessly, because we realize that this is important to the nation.
Following the end of Nigeria's strike action against the suspension of fuel subsidies this week, the economic cost of the country is beginning to come into focus. Wale Famurewa spoke to Yemi Kale in Abuja, Statistician General of the National Bureau of Statistics.
The best way to estimate this cost is, first of all, we looked at our projected GDP estimates for the first quarter. And the reason why we did this unlike many other analysts who use the GDP estimates for the full year, is that we observed that in the first quarter of the year, for probably obvious reasons, the GDP, the contribution to GDP in the first quarter tends to be a lot smaller than the rest of the other quarters, at usually about 18%. So if you use the GDP numbers for the full year, you tend to overblow the losses at the end of the day. So we use our estimates for the first quarter. Once we get that, we look at if you look at the relative weights of different sectors, different activities in GDP, you find that there are three sectors: the crude, oil and natural gas production, agriculture, and wholesale and retail trade, that account for over 70% of GDP. So obviously the impact on GDP will be dependent on how these three sectors were affected.
And from your report, it seems that it was really the wholesale and retail trade sector that was affected, right?
Yes, out of the three, because we know that the crude and natural gas production was hardly affected, that has been reported. We know that agriculture in Nigeria is largely subsistence. So it was obviously the subsistent farmers who didn't leave their farms to embark on the strike. And even we have representation in all 36 states and the FCT, and we have staff. And for what they told us, even the commercial farms, not many of them actually, well, a few of them continued their operations despite the strike. Even in the wholesale and trade sector, in the south and southeast sector, two very large markets, the Onitsha and Aba markets, were operating almost at full capacity. So even in wholesale and trade, even though it was significant, it was reduced by the fact that many of these areas and pockets of retail trade was still going up across the country.
All right, so it seems it wasn't as bad as most people anticipated. I know that some people have put that figure at close to $3 billion, but obviously the figure that you're putting out there is much less. But so in that context, what's going to be the impact for GDP for 2012, though? Do you think, my estimate is that that figure, 207 billion naira, is less than 1% of Nigeria's GDP. What can we anticipate for the full year? Many people are already thinking that Nigeria should be able to report between 7 and 8% GDP growth this year.
I think 7 and 8% GDP growth is still possible. Like you said, the impact on the, should I say luckily or fortunately, the strike happened in the first quarter, and in particular at the earlier parts of the year when people are just coming from the new year and so on. So activity is not really in full swing. So I don't think it's going to have significant impact, at least the strike is not going to have significant impact on our estimates for GDP for 2012. That being said, 207 billion is a lot of money. So yes, it's not something that we should, we're underestimating in any way. But yes, we're not taking it lightly at all.
UN economists project that 2012 will be a make or break year for the world economy in terms of proceeding with the slow economic recovery or falling back into recession. This emerged at the regional launch of the UN World Economic Situation and Prospects Report for the year 2012. Producer Buntu Williams spoke to Charlotte Dutoy, CEO of Plus Econometrics and Professor Ordinary at the University of South Africa.
Will 2012 be a repeat of 2008? Is the world teetering on the brink of a major downturn? But have we not heard it all before, and was it not expected?
To some extent, there has always been the hope that after the initial interventions, quantitative easing, etc., that would have been sufficient. So, yes, there has been the hope. But now, again, unfortunately, in hindsight, it is clear that we have underestimated the nature of this world recession. We have indeed not only experienced a slowdown in spending and demand, but that has resulted in some structural rigidities that we can now definitely see underpinning the employment performance of the world economy. So it calls for dedicated intervention. So have we been expected it? No, but we should have, because we should have understood that a recession means that there is a level cut and that the capacity in the world is declining, and that we've got less resources to work with, and that the longer that we actually extend the interventions, the dedicated intervention, this may become a reinforcing philosophy.
This emerged at the UN World Economic Situation and Prospects Report for the year 2012, held in Johannesburg in South Africa. Despite the need for a bailout in Europe and quantitative easing in the States, general sentiment is that these countries still have more room for aggressive fiscal stimulus.
I think at this point in time there is a lot of political tension. In the US there's tension about the possibilities of dealing with the implications of future tax rate hikes and the benefits that need to slow down, as opposed to the fact of pursuing with fiscal stimulus, based on the fact that the fiscal stimuli has not been that effective. So the question is that there is a debate going on, and therefore there's a little bit of a stalling taking place in terms of moving forward. The same applies in the EU, where they have to decide to what extent are the resources in the Euro region and zone is going to be utilized to bail out irresponsive economies. Question, therefore, is that ultimately what do these economies need to understand? They need to understand that there is a short run, the J-curve kind of impact that they need to expect, barring on the fact that the stimuli need to be redirected. It need to be redirected towards job creation and investment.
The UN has significantly downgraded its world gross product forecast from 6 months ago. The group predicts the global economy will grow at 2.6% in 2012 and 3.2% for 2013, down from 4% in 2010. The debt crisis in advanced economies and moderation in growth trends in emerging markets will impact trade rather significantly.
The fact of the matter is that yes, we will be negatively impacted by a slowdown in world demand through our trade channels. However, there is a lot of space because there are still economies like China, still Indian, with robust demand in the world, and therefore the opportunity still exists for us to improve our competitiveness. So actually, charity begins at home, and then a channel that is vastly underestimated, but really at this point in time is also underutilized, but and has been acknowledged, but we have to move forward forcefully, is the South-South trade and intra-Africa trade that we really have to start taking forward.
This will prove a poser for policymakers in Africa. Ugandan traders recently went on strike against high borrowing costs. So are there benefits to high borrowing costs in developing countries?
Certain economies who do face positive growth at this point in time would be attractive for the FDI that floats out there to be attracted towards these countries. And then also in terms of the lending for investors to come and invest in these countries, that the positive differential margins would actually also attract capital to these countries. So it's about, for these African countries, creating an environment that is conducive and attractive to investors so that they could actually invest in these economies.
Inflation appears to have defined much of fiscal policy management in Africa and East Africa in particular.
Inflation at any given stage is a relative aspect to be considered. It should be country specific. The fact is that one has to understand the nature of the inflation. Is it demand driven or is it supply driven? And the fact of the matter is that the majority of the African economies, it's lacking, it's because of a lack of productivity, a lack of production, it's competitiveness that is actually through the import channels, etc., that has got negative impact. So it's about restructuring the production structure, it's about restructuring trade, intra-Africa trade, and negotiations with the trade partners to actually start forcefully from a multi-dimensional aspects dealing with the inflation problem.
South Africa's economy is expected to grow at around 3.7% in 2012 and at 3.5% in 2013. But its inability to create jobs will only highlight growing inequality, and those jobs being created do not help relieve poverty.
This is a measure to compare the elasticity, the poverty elasticity of job creation. So it's a crude measure to identify the effectiveness of the jobs that we do create over time. Way back in the 70s, the poverty elasticity of job creation was 7-8, which means that 7 to 8 people were actually benefited from poverty alleviation perspective by the creation of one job. At this point in time, and that has been the case for a couple of years, the poverty elasticity of job creation of South Africa is just below 1, with the devastating implication that the person in the job does not receive sufficient remuneration in a sustained fashion to actually make a poverty dent in his situation.
Some in Labour believe that an inclusive approach can address job creation.
There's other countries that have had similar problems that we have, such as, for instance, Germany, that even through the recession, that the social partners were prepared to come together and to deal with the structural problems in our economy so that we can create the jobs that we need and to set our economy on a new path where people can see prosperity in the near future. Unfortunately for us, the situation is this, that on the side of the social partners, with government in particular, they battle to really create an environment which is conducive for economic growth and for job creation. On the side of business, we know that from our point of view, that business can do more and business can do better to create more jobs in our economy and to invest more in our economy and to show confidence and to stop looking at the weaknesses and to look at excuses, but to really focus together with organized labor and with government so that we can lift many of our people out of poverty.
The UN notes that Africa's economic outlook is subject to a number of downside risks, such as the conditions prevailing in the US and in Europe. The impact would vary as their economic and financial linkages to major developing economies differ across countries.
Meanwhile, the World Bank also warned developing countries to prepare for the real risk that an escalation in the Eurozone debt crisis could tip the world into a slump. From Washington, World Bank economist Alan Dennis explained the bank's Global Prospects report.
In 2011, growth in sub-Saharan Africa increased to about 4.9%. If you exclude South Africa, we are talking about a growth of 5.9%, making sub-Saharan Africa one of the fastest growing developing regions. Over a third of countries in sub-Saharan Africa in 2011 grew at above 6%. So those are pretty impressive growth rates if you look particularly at what is happening at the global level. In terms of 2012, we expect that barring any further escalation and the situation in high-income countries, we forecast that this underlying strong growth in sub-Saharan Africa will continue in 2012. Nonetheless, we have to be aware that there are significant downside risks to growth in sub-Saharan Africa. And depending on the severity of the downturn, if it is much beyond what we envisage, we could see growth dropping to about 3.6% in sub-Saharan Africa for 2012. But our baseline assumptions is that growth in sub-Saharan Africa will continue to remain strong in 2012. There are a good number of countries that they'll be having new mineral exports coming into our stream, including Sierra Leone, Angola, Ghana, Congo, etc. And that is going to help to accelerate growth. There's going to be a return to growth in Cote d'Ivoire from a minus 5.8% in 2011 to about 4.9%.
Okay, let's talk about restraint, Alan, because commodities will be drivers of growth, but other factors that have driven growth, consumption and also government spending. Let's talk about consumption and the ability of this new growing African middle class to spend. Wages are not rising in Africa and inflation is. So right there we have a discrepancy.
Well, actually, even in 2011, where we did see some strong inflation numbers, particularly in East Africa, we still saw signs of or evidence of strong consumption. Now, we don't have a lot of retail sales data on individual countries, but if you look at the strength of import demand, which is sort of a proxy to the strength of domestic demand, you saw that import demand was very strong. By our own calculations, if you just look at, take an example of, say, car imports, which normally consumers in Sub-Saharan Africa will spend on. We see car imports increased at about 31.2% in the region in 2011. So the growing middle income, which has been the case over the past couple of years, we expect those underlying dynamics, which is driving that, to continue. Now, this doesn't mean that Sub-Saharan Africa is immune from a severe downturn in the global economy, but the extent to which it will be affected will also depend on the extent to which we see the degree of the downturn.
After the break, more stories making headlines this week.